Protect your position. A stop loss may be the difference between losing 5% versus losing 50% on a trade. Yes, it can be that drastic. If you want to limit your losses, your trade management strategy must include a stop loss. How do you set it? I have 4 stop loss strategies, and I'm going to share each one with you right now. My name is Mike, and I teach you how to trade right now. If you want to make money in the markets, stocks, currency pairs, and crypto, you come to the right place. Maybe your technical analysis was off, sudden economic news was not in your favor, or institutional investors are manipulating the market. If you get caught in an unexpectedly bad position, it may be too late. To limit your trading risk, you need an exit plan. A stop loss can help you lock in profits and limit losses by exiting at a predetermined amount. Let's say you buy shares of Disney at $100. If you want to exit in order to control your potential losses, if Disney drops to $90 or by 10%, you place a stop loss order at $90. If Disney drifts lower than $90, your sell order is automatically triggered and you exit the trade. No trader is right 100% of the time, so a stop loss is a safety net for when things don't go according to plan. When I go long, there are 4 ways I prefer to set a stop loss. I use trend lines, support zones, chart patterns, and market structure. Let's jump into trend lines first. If markets are in an uptrend and I believe the trend will continue, I can go long or buy an asset in anticipation of its price rising. If markets are in a downtrend, I could also go long if I believe a price reversal is forthcoming. If you're interested in learning more about bullish reversal signals, check out the video link in the description below. In a downtrend, price will break out of the trend line and buyers gain control. There's bullish momentum with the potential to push price even higher. Price, however, does not move linearly. Sellers fight back and retest the trend line. One of 2 things will happen. Price action will break down through the trend line and the downtrend will continue, or price will bounce off the trend line and a new uptrend will begin. It's a 50-50 shot. But when we see a bullish engulfing candle, we know that buyers are in control and we can enter long. We set our stop loss below the trend line where sellers fail to push price lower. The first rule of thumb when it comes to setting a stop loss is to place it below the trend line. If sellers regain momentum, breaking through the trend line is an indicator they're back in control, and we want to get out of our position quickly. Let's head to the charts to see an example on pound USD. Price breaks out of our downtrend trend line after the 3rd touch point. Ironically, it takes 3 touch points to signify a strong trend, but sellers were not able to maintain their momentum. Buyers pushed price higher temporarily. Sellers stepped in and stopped price from rising. The trend line was retested. Will price fall, stall, or continue up? We wait and see. A bullish engulfing candle bounces off the trend line. Buyers are in control and it's our sign to enter a trade. We set our stop loss below where the wick crossed beneath the trend line before rejecting it. Our take profit target is our next resistant zone. A day later, we make $450 for every $100 we invested. Our trade was profitable. In addition to trendline rejections providing a signal to enter long, rejecting a support zone is another signal to enter in the grounds for our stop loss. In a downtrend, we expect price to stop at support because we believe price will rise. Support is most often represented by either an uptrend trend line or a horizontal line, and it's a place where sellers fail to push price lower. If you want to learn more about support and resistance levels, check out the video link in the description below. When price rejects a support zone, particularly if it's a bullish candlestick pattern, it's a signal to go long. That's exactly what happened with EURUSD. Before and after price broke through the downtrend trendline, sellers tried to push price below support. In fact, we can count at least 4 attempts to keep price low, but it didn't work. Each time, bulls fought back. Eventually, they won. A bullish engulfing candle broke through the support zone, but we do not enter right away. When price bounces off a support zone, we wait for the breakout, retest, and bounce off support. 2 hours later, a huge bullish momentum candle bounces off support, and this is our sign to enter. We set our stop loss below the support zone where sellers fail to push price lower. Our take profit is our next resistance zone. It takes 2 days, but we exit the trade profitably, earning $350 every $100 we invested, for a risk-reward ratio of 3.5 to 1. Rejections are signs to enter a trade, setting our stop loss either below the trend line or below the support zone. Confirmations can be entry signals too. Let me explain. Real quick, if you're enjoying this video, go ahead and like and subscribe below. With your support, I can continue to create free content just like this. It takes a second, and I so appreciate it. When a double bottom chart pattern appears, a trend reversal is likely. Double bottoms appear after extended downtrends with 2 valleys or bottoms form. The second bottom is unable to break below the price where the first bottom appeared. Support forms. Although price is rejecting support, we don't enter yet. We wait for confirmation. In a double bottom pattern, confirmation occurs when price breaks out of the neckline, which acts as resistance. Resistance is the price where demand is less than supply. There are fewer buyers than sellers, and because of this, price goes down. However, price went up, which is a signal that demand is increasing. You can either trade the breakout or wait for the retest. When it came to eurusd, I entered after the retest. After the first bottom, price encountered resistance and fell again. At support, price rose and eventually broke out of the neckline. Resistance is broken, but we don't enter yet. It could be a bull trap. Price action may in fact respect resistance, like it did before, and fall once more. To minimize our risk, we wait for the retest. For a few hours, we see only spinning tops and doji candles at resistance, which shows a lot of indecision in the markets. Finally, a bullish engulfing candle bounces off resistance, which is a signal to enter. We set our stop loss below the bottoms of our double bottom pattern. The neckline break was our confirmation of the pattern, and we set our stop loss outside of our pattern. Our take profit target is opposite where our downtrend began. The candles closed, and less than a day later, we doubled our money, achieving a 2-to-1 risk-reward ratio because we placed our stop loss below our bullish reversal chart pattern. It may sound simple, but uptrends are defined by rising prices. If an asset's price makes higher highs and higher lows, then we expect price to keep increasing. We call this market structure, and it helps us measure how markets move. It also helps us set stop loss targets. Let's look to Apple for an example. Price was making lower highs and lower lows until the trendline breakout. Then we see an equal high. Price is not rising or falling. Price is stalling. Indecision is setting in. Coupled with the downtrend trendline breakout to the upside, it's likely that bulls are taking control. We don't enter yet. We wait for a break of structure. If price was making lower highs and lower lows before, then a break of structure occurs when price makes higher highs and higher lows. 12 hours after our equal high, we record a higher low. 3 hours after that, we record a higher high. Not only that, but it's a huge bullish momentum candle. It's time to enter. Our take profit target is the next area of resistance. Using market structure, we set our stop loss below the break of structure or where our last lower high peaked. It only takes 2 hours to exit the trade profitably, making $300 for every $100 we invested, or a 3-to-1 risk-reward ratio. Remember that a stop loss is your friend, particularly as a new trader. All trade management strategies must use stop losses to effectively control risk and limit downside exposure in the event you make a mistake. The money will come, but make sure to limit your losses in the interim. If you found this information helpful, all I ask is that you like this video and subscribe to the channel. It takes 2 seconds and 2 clicks, and it means so much to me. Remember to check out my other videos, and thanks for watching.